Well, greetings and welcome to the August 2021 Investment Strategy Brief. We have a lot of content to cover, so let's jump in. Let's start with an outlook for a strong recovery. Meaning, what have we been thinking here in 2021? Well, if we go back to the beginning of the year, remember that our base case was positive, the idea being that vaccinations were going to work and the programs would go well, and that the federal government, both the Federal Reserve and DC, would be supportive in terms of monetary and fiscal policy. And of course, that's panned out. We've sort of edged to the bull case, meaning things have gone pretty well pretty quickly. And earnings are recovering. We'll talk about that. But we're also mindful of the possibility of the bear case. Will we see a move down in the markets? And what are some of the things that we're monitoring that could cause that? Well, the first is one that we're wrestling with, which is a troublesome variant. So most importantly, we want to see if vaccines are still are effective with the virus and not resistant, or the virus isn't resistant to the vaccine. But also, right now we're dealing with the Delta variant, which is, spreading around a bit. So that's causing a little bit of trouble. Anyway, another factor that we're mindful of is market excess, meaning market valuations are very high because there have been good returns and things are richly valued. And that's always a time when the market gets a little more sensitive. And then finally, and we'll get into this, inflation heating up too much. Has this recovery led to inflation that ultimately is going to lead to the Fed having to act to increase interest rates? And we'll get into that. Now, when we do our work, basically we evolve and develop different investment themes. And the two I want to focus on this month a little bit are productive competition and shifting demographics. Okay, productive competition and shifting demographics. Basically, we want to start by focusing on China and the competition between the U.S. and China. Here on this page, basically what you'll see is that the U.S., from an economic productivity perspective, is a leader, right? With almost $21 trillion in GDP in 2020. Second is China at just shy of 15 trillion. But I think what we're all aware of is that China's growth rate is much faster than ours. So they're just sort of chipping away and growing and growing and growing relative to us. And there will be a point in the future where they might surpass us as sort of the world leader when it comes to GDP. And that's sort of a key focus for them is becoming more and more relevant. Now, as it relates to the U.S. and our strategy for sort of economic development and being a dominant player in the world economy, I would say what's interesting about the U.S. is while there's this undercurrent of innovation and really sort of corporate and private-driven effort and work and growth and all that, as it relates to the government's role, it obviously is influenced by elections, who's in power, and what the focus and sort of programs are that particular group is trying to advance. So in today's world, our long-term strategy really focuses on things like infrastructure and what the current administration has tagged Building Back Better. And that's meaningful, right? So you take infrastructure investment. Right now, that's forecasted to contribute an extra $10 trillion in U.S. GDP by 2039. So having an important impact. In any event, another focus by today's standards, kind of a smaller number, is this U.S. Innovation and Competition Act, $250 million, basically to boost U.S. Production, for example, of semiconductors and boost scientific research and development, things like artificial intelligence and even space exploration. And that's all being mindful that a lot of sort of the computer chips and semiconductors come from outside the U.S. So this is a move that's just designed to bring some of that back on shore, again, a way for the U.S. to be competitive. Now, from China's perspective, they're very interesting to kind of evaluate because they have a very long-term focus. So they've come out a number of years ago and said, hey, by 2049, they want to be a, quote, fully developed, rich, and powerful, end quote, nation. And they have these series of 5-year plans. So they just always have in mind this kind of the willingness to experience some short-term pain to advance this national focus. And so here are a couple of things, and we're going to get into this a little bit later too, but that are sort of in focus for them. One is what we've tagged here as social change. So think of it as that demographics, right? That essentially because of the birth rate being low and people aging, their workforce is going to decline incrementally versus where they want it to be. So the action they've taken, which is very sort of classic in an approach from China, is to allow couples to have, instead of 2 children, 3 children. And interestingly, it was the trigger, we think, that caused them to basically require the private education sector to move to nonprofit. So the spirit of it was, hey, it's kind of expensive to have another child, so let's do something to make the cost of that private education support a little less, that would marginally and incrementally motivate people to have kids. In any event, the other thing that's been in focus is what we would think of as an impact on economic change, which is essentially China taking a look and seeing what they have to do to become more competitive. So all this news, for example, about the antitrust reviews and investigations that they're doing, and sort of strengthening and tightening the approach that they want their tech companies to take, is really about, we think, them wanting to become more sort of trustworthy and competitive on the world stage as it relates to their technology. Now, something we've looked at in the past, but just to remind ourselves, things like patent applications. China has just accelerated and has just grown a lot in terms of the patent applications that they've submitted, really about intellectual capital, right, and intellectual property. And so here, then as well, research and development, while we and countries like Germany and Japan are above China as a percent of GDP focused on R&D, you can see China's line here on the right here accelerating more quickly, so they're catching up with us. So again, that competition is present for sure. Now, another thing you hear a lot about is the Chinese consumer, right? They're building wealth and becoming more present in terms of their consumption. And you can see here on the left of this chart, basically China's kind of catching up to the U.S. in terms of their share of global consumption growth. And then on the right, an increasing share of the luxury goods are being purchased by Chinese citizens. What I found was interesting was the bottom right here, which is this idea of the China's Singles Day, where they basically motivate and sort of invite, if you will, transactions, that the scale of that effect in terms of the consumption that's done, you can see is in excess of what happens here in the U.S. for the different sort of Black Friday and Thanksgiving weekend and Prime Day and things like that. So again, they're a strong presence when it comes to global consumption. Now, the pandemic has affected things a bit. We know trade-dependent economies, certainly China is one, has been affected by the pandemic and by COVID-19. And there's been spillover effects where China's had to shut down factories. That's meant, things have kind of slowed or stopped for a bit in terms of some of the goods and services that we consume and others consume around the world. Obviously, the pandemic has motivated basically R&D spending and an increased adoption of digital practices. So everybody's focused on that. And then, interestingly, just in general, people are having fewer babies during the pandemic. So that falling birth rate is one of the things we think China's looking at in terms of that workforce down the road. So another interesting study, the World Economic Forum basically is out there. They talk about and created the fourth industrial revolution concept. But another thing they're focused on is sort of how countries are evolving and transforming their economies to become more sustainable and inclusive. And again, you can debate whether that's the right thing to do from a capitalist perspective, but the bottom line is this is something that's in focus. And when we see things like energy transition, progressive tax, the concept of public and private collaboration, R&D, these are all things that both the U.S. and China do pretty well, each in their own way better than the other in certain circumstances, but again, on average, quote unquote, better than other countries. So I find it interesting simply that an organization like World Economic Forum is tracking this kind of thing. Super interesting. Now, finally, as it relates to sort of this special set of topics, I mentioned the idea of sort of the growth of populations and what does that mean to the labor force. Bottom line is, when we look out to 2028 and you look at the age of the workforce, essentially there will be a quote-unquote shortfall here in the U.S. by about a little over 10 million employees, if you will, workers. That's about 5.5% of our workforce, our labor force. When you look at China, they're going to be short by 35, 40 million. 4.1% of their workforce. And that's, again, the kind of thing that China's looking at when they look at their policy for letting people have kids and how to support that going forward. All right, let's now take a look at a pandemic update. Now, here's some data that we all are living and swimming in day to day. On the left here is essentially the new surge of daily cases that we're seeing because of the Delta variant. And then, that's a pretty steep curve, right? What we've seen is both with hospitalizations and then as presented on here, unfortunately, deaths, they're growing too. But, it's not really great news, but the okay news is that not as fast. What that means, we think, is that the vaccinations are working in the sense of people aren't getting as sick, aren't getting hospitalized, unfortunately aren't dying as frequently because they have the vaccination, and that's helping. In any event, on the right side of this page, you can see this march towards whatever percentage will work for us in terms of herd immunity. Remember, it's a combination of vaccinations, people that have gotten sick, or maybe people who had been sick and still got vaccinated. But the bottom line, you stack all that together, and here in the U.S., we're above 70% of the population that's quote-unquote protected. And yet what we're seeing is the Delta is a tough variant, which means we have to go higher, I think. Now, that's been a little bit tough because when we look geographically, as we've talked about before, the Southeast and the non-coastal part of the Northwest basically are areas where citizens are less likely to be vaccinated, which means the virus can spread more aggressively, especially in those areas. And so that's something that we're all watching. We think vaccinations should pick up a little bit for two reasons. One is we think that the FDA will fairly soon sort of formally approve them. And then we think this spreading of the virus is basically creating kind of a vaccine scare, meaning that people are like realizing, oh boy, I really should get a vaccine, and they're stepping up and going and getting it. Now, as it relates to protection against this Delta variant, basically studies so far have mostly shown that the vaccines remain effective. There was one study out of Israel where the efficacy dropped to kind of 40 to 50%. And what's interesting about that is that Israel's was one of the early populations to get vaccinated. So that is sort of building speculation that we'll see some booster shots coming. In any event, overall, the spirit of it is that Delta is there, but the vaccines seem to be effective against Delta. Now, here's an interesting chart back to sort of the U.S., how the U.S. has sort of played out its vaccine rollout. So you can see early on we were sort of one of the sort of steeper curves, right? So we got a lot of people vaccinated quickly, but then we've leveled off. Sort of there's a good chunk of our population that for this reason or that are not really interested in getting vaccinated. And then when you look at other countries on this chart, Western Europe as an example, basically their lines are sort of more constant and going higher, meaning that they're accelerating their rollout. And, bottom line is that's good for their population in terms of moving towards herd immunity. So again, we hope to see sort of a pickup in vaccinations here in the U.S. What does all this mean in terms of mobility? So everybody's kind of anxious that the Delta variant, wearing masks again, having to show vaccines, be vaccinated to go to certain jobs, whatever it might be, may slow the reopening down, may slow mobility and action and activity down. Bottom line is the mobility data is pretty stable. So when it comes to retail, recreation, things like going shopping, grocery store, pharmacy, we're all pretty much back to where we were pre-pandemic. And then what we are noting is that still a lot of workplaces are remaining remote. So people are a little bit quiet in terms of going back to the office, and that's affecting as well then commuting and transit as another example. In any event, what I want to turn to is sort of the macro environment. Here we've got the recognition that this pandemic and the recovery from the pandemic is affecting the economy, that in turn is going to affect the markets. So let's jump into the macro environment. As I've alluded to, basically we're in an above-trend growth environment. And whether we peaked last quarter or we're peaking this quarter, we're kind of right around the peak in terms of this robust recovery. But what you see from this graph is that if, long-term trend growth is just below 2%, basically the forecast is that we're going to be above trend through the end of next year. So a robust economic recovery. And that's sort of reflected in the numbers. So here on this page where we sort of have this color coding, if you see green, that's good. And so we're sitting here looking at things like consumer confidence, spending, PMIs, so that's purchasing managers indices, and business optimism, industrial production, a lot of business measures, all green, which means, hey, things are looking pretty good. The negatives on this page are really two. One is unemployment, so 5.4%. That's much better than where we've come from, but it's still pretty well above that 3.5% record we saw right before the pandemic. And then, of course, as I've mentioned, inflation, in this case, CPI. In fact, when we expand our look to inflation, you can see all kinds of data pretty much in the red. The PPI, for example, almost 8% year over year with this last print. That's a big number. We'll see if that gets passed through to the consumer. Some of it probably will, some of it probably won't. But what we're very mindful of is these break-even inflation levels. So the 5-year break-even and 10-year break-even, running around 2.5%. We think that's a level that the Fed will tolerate, meaning they won't increase rates if inflation falls, to the 2.5% range, let's say starting next year. Now, one thing we are mindful of, this is just one data point, so these kinds of patterns aren't locked in. But when we look at purchasing managers indices, so here it happens to be the ISM series of manufacturing and services, they are often a leading indicator to inflation. So basically what you see is these lines for ISM and manufacturing and services going up. When it goes up, the blue line goes up, that's CPI. And so we're at this pretty elevated level, which is supportive of where CPI is right now. But again, it's not like a perfectly correlated relationship. And so, the Fed and others think that this inflation is transitory. I mentioned the break-even inflation. So when we look over the next year, it's up around 3%, 5 years and 10 years above around 2.5%. And then when we look out 5 years from now for the next 5 years, just above 2%. So we think the Fed will tolerate that. Basically, just above 2% is very close to their 2% target. Now, this dot plot on the next page is, remember, the Federal Reserve. Each individual dot is a voting member of the Fed, where they're saying, here's where I think the Fed funds rate is going to be at this date or that. And you can infer sort of the average view and with the timing of it. But to kind of get to the punchline here, basically the Fed's signaling 2 rate hikes in a couple of years. So think of it as, let's wait a while before we increase rates. They believe that the recovery is going well. Unemployment will continue to fall. They're targeting 4.5% by the end of the year, and higher inflation this year, but calming down next. So they're calling inflation transitory. But one thing that's been in the news, and this is how the Fed works, is lots of public appearances and statements where they're really starting to talk about ending their asset purchases, which is stimulative and supportive of the economy, by the middle of next year. And that's kind of new news, meaning that they've been talking about it. Now we've got Fed officials sort of informally signaling that that's their personal view. That'll get sort of developed and sort of formalized in their meetings. But we have to sort of anticipate the end of asset purchases. Now, on the policy side, as I've mentioned, there's basically a couple bills in motion. The infrastructure bill at $1.2 trillion, which is said to be bipartisan, but we'll see with all the different views in Congress whether it actually gets passed. And then we've got a $3.5 trillion soft infrastructure bill that includes tax hikes that they're trying to work through the budget reconciliation process. So there's a view and sort of the market's anticipating the likelihood of tax reform with increased taxes that will have an impact on earnings, for example, if that were to occur. But remember, the market's a bit forward-looking. So at some level, this anticipation is kind of priced in. I mentioned a little bit employment. What's very interesting is there are a lot of jobs available. You walk around your town, probably you're going to see help wanted ads, and sort of the buzz is that everybody's sort of struggling to get people to come take jobs, right? It's hard to fill positions. And, long story short, so we still have a lot of people, quote unquote, out of work, but a lot of jobs. So there's some friction between the two, but we would expect, basically employment to grow and for unemployment to fall here in the coming months and into next year. That's important in part because the consumer, remember, consumption is 2/3 of GDP. So unemployment's super important, confidence is important, and then here we see both retail sales and savings remain above normal levels, in part because of the fiscal stimulus checks, but also that idea that the consumers are confident. Now, one area where we've seen things soften up a little bit, there was lots of chatter about, the purchase of cars and dealers running out of cars and prices going up on used cars and all this. That inflation, same thing with housing and other large durable goods of the household, basically that inflation, that increase in prices is now showing up in a tempered level of demand from the consumer for buying these specific goods. So that's something we have to watch is, does higher prices, does that sort of slow things down? So we're monitoring that pretty closely. Now, finally, this all wraps up to kind of GDP forecasts. So essentially, again, for 2021, the forecasts come in the 5 to 6% range, which is well above that sub 2% long-term growth rate. And then even in 2022, we're seeing forecasts in round numbers in the 4 to 5% range. So again, above trend growth through next year, and that's all, if you will, priced in to the market. Okay, so let's take a look at the markets. And I like to start with interest rate, which is sort of interest rates, which are basically foundational to the market. So we know the Fed funds rate is down to zero. They cut it. They're going to keep it there for a while. Things like the corporate spread, which is the amount of compensation to buy a corporate bond versus a treasury bond, that extra compensation is sort of at about 1%, and that's a very low level by historic standards. That means investors are pretty calm and they're pretty confident. We've talked about break-even inflation, and then on the upper right, basically the 2, 10, and 30-year bond rates, a bond yield. And you can see earlier in the year it rose. It's fallen a little bit through the scare of the Delta variant. Now it's inching a little higher. So what does that mean in terms of looking ahead? Well, when we look to the longer term, we can look into the current pricing of Treasury securities and infer what the market thinks is going to happen to the 10-year over time. And basically what this is saying is it's going to take about 10 years to get back to around 2.5% or so, which is, a very slow, if you will, rise in interest rates. And then when we look at the consensus view for where the 10-year is going to be at the end of this year, basically the view is just around 1.8%, around numbers. And so the bottom line is the market's sort of signaling the view that interest rates are going to stay low. Turning to equities, we all know about the roller coaster last year. When we look at this year, we started, with a little bit of volatility, but long story short, it's been a good year so far. Valuation levels are pretty high, but what that means is we've had good year-to-date returns, and we'll kind of keep watching that pretty closely. One of the supports for that is earnings. So basically this chart, a little bit complicated, but every line is a different reporting period. And essentially when you see the line going up, what that means is that analysts are increasing their forecast for the reporting period. So they've been doing that since the middle of last year, and the lines are all going up. But what's super interesting is that even with that, what happens when we get through the earnings season recently is on average, companies are surprising on the upside, meaning even with all of this sort of adjustment, analysts on average are coming up with consensus earnings estimates that are below what actually happens. So positive surprises, which again is just generally speaking supportive of equity prices. This year, we've seen a drawdown in 2021 of a total of 4% peak to trough during the year, and yet year-to-date still a positive return. What's important to understand is that down 4% is actually kind of muted relative to other years in the past. And what that tells me is that, hey, there's still room, we've got time, and there's always the possibility the market it could sort of retract a little bit, see a little bit of a correction. I believe that sort of fundamentally things are strong, so even if that were to happen, I don't think it stays down for long, meaning that the markets could recover pretty quickly. But again, that kind of risk is something that we're mindful of. Here's an example of that in terms of the kinds of things that we're watching. So here's an interesting chart in that on the right of this is basically the total balance sheet for the Fed and other central banks around the world. And what you can see here is that it's been sort of inching higher. It sort of fell off in the years, just a little bit in the years prior to 2020. And then with the pandemic, basically, boom, everybody's growing their balance sheets. That's the purchase of those securities, which I mentioned earlier. And on the left, basically relates the year-over-year change in money supply to the year-over-year return of a portfolio. So think of it as the balance sheet moves around, so might a multi-asset class portfolio. So the idea is that these increased balance sheets are supportive of asset pricing. So what we have to be mindful of is that as the Fed starts to discontinue their purchases, and then eventually, bonds mature, et cetera. Long story short, basically the balance sheet starts to decline, and will that lead to a decline in asset class prices, asset prices? And, you can see on the left, though, this is not a perfect correlation, but it is the kind of thing that we're monitoring for sure as it relates to that volatility. Okay, let's turn to our dynamic leanings, which are unchanged since last month. So remember, we have this framework for asset allocation, but the real thing to focus on here is within the equity markets, we're a little bit overweight non-U.S. stocks. Within the U.S., a bit overweight large value and small cap, all sort of anchored on economic recovery. When we look at fixed income, we're overweight TIPS securities. Those are basically securities that allow us to hedge a little bit this higher inflation. And then for those that are actively managing high yield, hiring mutual funds or separately managed accounts, we're a little bit overweight high yield. So that's another sort of leaning. And then finally, if you look at the slides and the notes of this video, you'll see this next page, Stifel Guidance, basically links to all of our work. So this video, other videos, podcasts, etc. And we, obviously share it in case you want to check it out and see some of the other content that's available. So thanks very much for joining this month, and we'll look for you in the next episode. Thanks so much.